You know who doesn't need a whole life policy?
Yeah.
Most people,
Right.
right?
Okay.
The idea of this growth really is about, and if you're not just looking at trying to keep up with a growing liability, it's great for. But when you're looking into the tax advantage investing piece of it, which has become the huge push in the industry, is that this is, grows tax free, all these things. But most people don't have the tax problems that require this tool. Their average tax rate's 26%. They still have TFSA room. They have RRSP room. There are so many other avenues that they can take and use to get tax advantaged investing.
Hi, and welcome to the Millennial Money Canada podcast, episode number 22. I'm your host, Guillaume, and thank you for taking the time to listen to this podcast. If you're a new listener, welcome. Our goal with this podcast, as usual, is to elevate your knowledge about finance, financial planning, so that you can live well, build wealth, give generously, and leave a legacy that you're proud of at the end. Today on the podcast, I have a guest, Graham, the founder of G3 Wealth Strategies and Consulting. Graham has a decade of experience in insurance, has implemented over 3,000 insurance plans. He's deeply passionate about the world of insurance and understands every facet of the insurance business. The reason why I brought him on the podcast is because I wanted to pick his brain and tap into his deep expertise into permanent life insurance. And if you've been listening to this podcast, you know that me and the permanent insurance landscape have a dicey relationship. The focus of today's episode was to understand, of course, the need for permanent insurance, like who is it suited for, but also how to structure a policy properly. What are the differences in products out there and carriers, how insurance fund companies manage their investment portfolios, their par dividend funds, and then we covered also, other topics related to permanent life insurance. So if you're a business owner and you've been pitched permanent life insurance, or you're looking to buy a permanent policy, this could be useful. Although today it was more generic, and we will have a follow-up episode specifically for corporate owned life insurance. And we also will have a follow-up episode for charitable giving using life insurance or permanent life insurance as well. So with that being said, let's go to the episode. Graham Bergsma, welcome to the Millennial Money Canada podcast.
Well, thank you for having me. I appreciate you.
Can you start by giving the listeners a little bit of color on, your background?
How far back do you want to go? It's a fun stories. All the way back to childhood, or just more when I got into the industry?
Well, I think one thing I want you to talk about is lacrosse and, maybe, from university, but mostly from your time at university, your lacrosse times, even how you're involved in lacrosse today, and then kind of that path to the insurance space as we kind of previously talked. Like, if you can just summarize like what led you to, where you are today, and also like being the founder of G3 Wealth. So kind of that.
Perfect. So yeah, I was fortunate enough to play down in the United States in the NCAA D1 for lacrosse, and I got my undergraduate degree in finance and math because at my heart I'm a nerd. I love numbers. But then I did my graduate degree, playing my fifth year of eligibility in education. I got a master's degree in education. Financial literacy and getting those points across has always been really big to me. And so those were two very important pieces to me. And then I ended up getting recruited by a lot of the sort of major career shops. So Sun Life, Freedom 55 at the time, Edward Jones. But I was still kind of going down this path with lacrosse and coaching. And I actually ended up moving to Berlin for a year and was running a program there, everything from the youth program up to the men's team, and was also subsequently running a daycare, which I was able to do because I'm also a Dutch citizen, so I had EU citizenship. So working there wasn't that big of a problem, and that was fun in of itself. And then I was playing in the World Championships in Denver and got an opportunity to be a professor and coach in the NCAA in Michigan. Went and did that for a year, and then kind of didn't really want to continue to be a nomad, kind of traveling all over. And so I decided I was going to come back home, grow some roots. And I reached back out to those firms that had tried to recruit me in the first place. And I ended up picking Freedom 55 for organizational values, but it was really the manager that I was dealing with there who was tremendous support. And I was relatively successful there quite early, but then I ended up getting an opportunity. I was headhunted by Ivari, who was formerly Transamerica, an insurance company. And, you know, that channel had always been, there's managers, but what they really wanted to do was look at changing that model and really coaching as opposed to managing. And so they saw my background, both success as an advisor and my background in coaching from sports, and they decided they wanted to go that route. And they were trying to do something really interesting where there's the career shop model where you sell one company and they train you and you just have their products, and that's how that works. And then there's the full brokerage model where you can kind of sell anything, but it's not that same level of support, or at least it wasn't. And so they were trying to bridge that gap and try to bring career shop level support to brokerage advisors. And so we were really successful there. But decided to move on and ended up at Financial Horizons, which is one of the largest sort of independent distribution companies in the insurance and investment space in Canada. And I was running the Toronto office and eventually the Toronto, Barrie, and Kingston office, and ended up reworking alongside a colleague of mine, Andrew Murray, reworking the entire way in which insurance specifically was positioned, and especially in the high net worth market. But really it was about the process. I looked around at how investments were being sold and said, this can be done better. We're not engaging, not just clients, but every stakeholder in the process aren't being engaged the way they want to be engaged. So we reworked even just the way that we position these strategies so that clients can relate to them, that they can understand them, getting rid of acronyms and jargon, helping it be very simple idea for them to get behind. And then a lot of people in the financial services industry treat the rest of the professional services community not as well as they could be. They treat the accountants and lawyers like they're the boogeyman. And we came from an understanding of their expertise, their insight into a client's situation, ongoing future is so important. And so we wanted to get them involved very, very early in the process. And then from there, it was all the relationships that I created with, carriers and distributors and other outside sources, whether it's specialized lending, et cetera. And we just reworked that whole process to make sure that every single person that touches something along the way is getting the best possible experience. So clients get better advice. They enjoy their time going through insurance and investment application process, underwriting process. They enjoy it a lot better. You get better success. It takes shorter sales cycles. And so advisors were seeing a ton of success being able to write bigger cases, write more cases with the same amount of time. And so exploded the production there at FH. And then, eventually decided I continuously grew more and more towards independence. And so the next logical step was going out on my own and creating G3 Wealth so that I could work with all the MGAs, work with the career shops, work with whoever was the right fit. And so that's sort of the progression of how I got into the industry and how we grew and how I ended up now in what can only be seen as independent as I can be. And that's what I strive for.
Fascinating story, man. Thanks for sharing. I know you just came back from a trip to Czech Republic.
Yes.
How was that?
It was incredible. So I still play semi-professional and international lacrosse, and the Czech Republic has the world's biggest club team tournament every year in a suburb of Prague called Radetin. It's unbelievable. It's this outdoor box with the clubhouse there, and it's just the whole community is just centered around this rink. So you've got, you're playing games and there's little nonas reaching out their balconies to look over the game. And when you get to the later stages, there's 2,000 people there. It's just an incredible thing, people from all over the world. And one of the things that they did was introduce a sort of friendly tournament alongside it for the actual national teams to play. And so this year, different than most years where it's kind of all in the same week because of Easter, was there for this tournament playing with the Oshawa Green Gales, who I never played for in junior. They were junior B, I was playing junior A. but they espouse the values of family, honor, pride, tradition. And I was lucky enough probably about 10 years ago to be seen as someone who also espouses those values, and they invited me in to come with them. So I've been going ever since, and that went great. But the real experience for me this time was I was asked to coach the Dutch national women's team. And I was actually going to play for the men's team on their side, but ended up coaching there as well, just because we're sending a development team and we figured it was better for the program. And that was just brought me back to what I love about the game, what got me back in international lacrosse, what really drives me. Like the group of women were just so incredible, how much they learned over the course of that week, how much they came together, how dedicated they were, and seeing some of the, especially the adversity that we faced during the tournament, and seeing them fight through that and stay calm and see that growth in them, not just as players but as people, was really 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 cool. So it's really reignited my passion for the game.
That's awesome. That's awesome to hear that you had a good trip, good experience there. I love your experience with coaching, whether it's through lacrosse or even coaching advisors today and the way you're mentoring. When you look at, your experience, either when you've been coached or the people you're coaching today, what would you say is not what is wrong, but what would you say is not in the best interest of the clients or even like the advisor themselves for their own success around the insurance industry in general?
I think I'll speak to how we go about it, and maybe that'll highlight the difference. One of the questions the advisors will come to me and say, oh, "Okay, the client wants this, this, this," and I always try to take a step back and ask, "Okay, that's what they may have asked for, what you think, but what are they trying to accomplish?" I think we don't have the difficult conversations enough. Sometimes it's, "Oh, this might be a sale. I'm just going to try and give them what they want," as opposed to really taking a step back and maybe having a difficult conversation that may lead to nothing, but if done properly, will actually ensure that the clients are opening up to get more information, to be open to more ideas, so that they're actually going to get what they really want. Sometimes what they want isn't necessarily what they want or what they need, but they've just heard it from someone, or it's a buzzword or something else. And generally, what they're actually trying to accomplish might be better served by something else. And so being able to say, okay, this is what you asked for, but here's another way of looking at this that may actually be able to accomplish your goals even better, is something that I think if we all took a step back and had those conversations at the front end of engagements with clients, that clients would be better served and the industry would be in a better place.
Yeah, coming back to identifying the goals and making sure that like the products is well positioned for that. Here at Millennial, we're like a full-fledged, just in terms of like full-fledged financial planning, and then that's kind of teeing up insurance and investments. That's how we position it, right? But in Europe, in your opinion, like to make sure that you've clearly identified the client's goals and you kind of know everything, what would you say is the best way to capture everything? Whether is it through a financial plan, is it through needs and not like what would you?
I think it's through a conversation. I think it's through something that goes beyond. I think, financial plan is a wonderful piece that really helps put all that stuff into context and can give concrete sort of forward thinking to what, not only what does this look like now, but what it's going to, or potentially going to look like going forward. What are the ramifications? If you don't, without a financial plan, sometimes we can be short-sighted, right? You think of, okay, a lever and what's that effect now, but seeing that ripple effect across so many things and how a good, well done financial plan brings that to the forefront is really important. But I think if we don't have those tough conversations, we don't have those conversations on the front end, sometimes the data that we're putting into a financial plan or into a needs analysis is compliant, but it may not have all the context that's needed. And so I really believe that getting to the heart of what a client is trying to accomplish and getting them to go through that process, because sometimes they don't even really know. Like it's as simple as
Yeah.
I want my money to disappear. I want to be good. Hey, what does that mean? What does that look like? What is retirement? What does that mean to you? Oh, I want to be able to retire comfortably. Okay. Are you going to want to travel? Are you going to keep working? Are you one of those people like me that will never really retire, but you want to keep doing other things? Are you going to, all of those other questions that come into it? Because, you know, a great financial plan will say, okay, we're going to grow your assets by this much, and then you're going to need this amount of income. But without understanding what that money's going to do or what that money means for a client, it's not that it's wrong, but, you know, it may not fully encapsulate what they're looking for, which I find is security or peace of mind. Clients want to be in a position where they're not worried about stuff. And I think a financial plan is a wonderful tool in that. But I think on the front end, we can help that financial plan to be even more accurate, to be even closer to what they're really trying to get at with some good, tough conversations.
Yeah. That's a really good point. As part like of our process, like we have that one non-financial meeting, which is called like goals and values. And it's been 2 years that we're refining the script. Every single goals and values meetings and every client we onboard, we get to learn more and more of like, what are the better questions could we ask, and as well as talking with other professionals in the industry, like what are their script. Has your script evolved, or are you more like off the cuff? What's your process on capturing those non-financial information?
I think I wouldn't call it a script, right? But when you've
Sure.
done and been through
What?
as many cases, you start to understand, and it depends on what industry they're in, what type of work they do, everything else. They're going to have a different day to day, different pain points, and so the base of it is relatively the same. But being able to sort of mold that for each individual has certainly evolved over time. And what I really like about what you're talking about is the goals and values, because I think that's the biggest thing, is the values, right? Because especially math nerds like me, can tend to look at numbers. Say, okay, well, this one has a better rate of return. It's therefore better. But I tell a story a lot where I was showing a set of insurance solutions to a client, and according to the numbers, there was a few that were very, and there was one that was an outlier on the low end, but the client chose that company to go with, and so I was a little taken aback, but said, "Congratulations, that's awesome. If you don't mind me asking, what's making you choose this one?" And they said, "Well, my dad had a policy with that company and he died when we were kids. And that money came in and that kept me and my sisters off the street. So I know they're going to pay out." Let's not focus on the fact that that prior experience means nothing about future experience. It doesn't mean they're going to pay out, but it was, the almost 100 basis points, which was in this case millions of dollars in difference, at least in projected values, was not as valuable to them as that peace of mind and that security knowing there was going to be a payout. And so early on in my career, I had to realize that like what I think is important is irrelevant, right? What you think is important is irrelevant. What the client thinks is important is so relevant and so at the heart of everything. And we've got to be able to get rid of that ego and look outside of our own personal value system and make sure that we're applying all of our, soft skills and technical knowledge to the client's values. And that's really what I try to do. And I can't do that if I don't know what they value and what's important to them. So I really try to get to
Yeah.
the bottom of that early.
Yeah. Man, that's so key. That's something that I've like really, really, really worked on. And now, like, getting a lot better at it in terms of, like you just said, bridging the gap between what mathematically or the numbers say and what they actually really care about and want to implement and will, implement successfully. Right. And bridging those, because you can have the best plan in the world if they're not buying into it, like someone in the industry, says it's expensive toilet paper, right? That's a,
It's so true. And that's where, another thing I had to learn, like I'm sort of regarded as one of the people with the most technical knowledge, especially on product design and everything else in the industry. But one of the things that I learned is all the technical knowledge in the world means nothing if you can't get that across to the person across the table
Mhm.
from you. If they can't feel like they get it, like they can have some ownership in it, like they truly are making that decision from an informed perspective, it doesn't really matter, right? And too often the technical leaves clients sometimes more confused than before they got this wonderful, perfect plan. But if they can't feel confident in it, then it's not doing its job. So I'm taking a step back on some of the math to focus more on the person in front of you has been a big progression in what I've been doing.
Yeah, that's so key. So today we're gonna dive into the technical side of things.
Yeah.
No, but that's why I brought you on the podcast, right? Because of your deep expertise, and that's a great tangent. into kind of the crux of this episode in a way, which is I want to dive into the whole life insurance specifically. And then I want to ask you like a number of questions based on the strategies that you implement, your clientele, and who do you, again, like your bread and butter, right? Like your expertise. So I want to tap into that. And yeah, so that's the my goal. But so just as a high level, just to set the stage, that we already did it in an episode previously, which listeners can check in the podcast about, is life insurance in need or a preference, where we talked about term versus, permanent life insurance. But at a high level here, can you just recap, what are the bells and whistles or the characteristics that are attached around a permanent life insurance that, you wouldn't find in a buying term?
So the idea of permanence, right? So term policies, for the most part, stop at a certain age. And so they're meant specifically for mitigating risk. It's if you die early, but they don't serve the person. Well, they do, because they're covering off those risks while they're there, but they don't serve those risks that exist even if someone lives a great right to a ripe old age. If they live to 95, that term policy is no longer there, or it's been extended and it's been just prohibitively expensive over the course of it. And so permanent insurance is to deal with those risks that are permanent. For people that are building out, they've got a second property, they have assets that they're going to be passing on to another generation. Well, the government wants to take their piece. So permanent really can serve to get rid of those liabilities that aren't over a certain term. They are in perpetuity. Now, that's the pure risk side of things, where permanent has evolved with, originally with universal life and some of the things there, and now more prevalently with participating whole life, is accessing some other benefits. So one, growing, knowing that if you've got say a second property, you've got a cottage, and that's got a permanent liability on it, but that cottage is going to continue to grow in value. And so instead of having to buy more permanent coverage all the time as it gets more and more expensive, if you can have a policy that grows alongside that liability, then great. You do it once. You don't have to talk to your insurance advisor 10, 15 times over the course of that to buy more. You can save more money. You can get access to it. The other piece that's become really, really big is the cash value component. And I think that has probably become overly valued both by advisors and by clients, but that provides a lot of additional benefits. One is flexibility. We don't know what the next 10, 15, 20, 30 years are going to bring, whether that's good times or bad times. And so having a reserve that gives clients the ability to change on the fly by accessing some of that value is really important. It's been pushed, that flexibility has been pushed really far into the ability to alleviate opportunity cost. So especially in the high net worth market, you've got people that have done their planning, they understand they've got these estate problems that they want to deal with, but they got wealthy by spotting opportunities. So if you're putting, $100,000 a year into a policy, and all of a sudden 6 years after you started, a wonderful real estate opportunity comes up. Well, that's $600,000 that, yes, you're getting a great rate of return. You're helping your estate value down the road, but you could do more with it if you had it to put into this opportunity now. And so cash value and the new flexibility of policies has made it so you don't have to choose anymore. You can actually have your cake and eat it too. And so it's basically added that growth, and it's added another lever that clients can use to have some more control in the long term over how they're growing and how they're spending their money.
Well, I'm going to question a number of things in terms of the bells and whistles that I attach it, one by one. But I just want to go back to the point as to kind of who is this suited for. And for example, like right now, you just kind of mentioned, first of all, $100,000 policy, like those are massive policies, right? This is like for like the top 1%, right? Or something like that.
So I
So
wrote an article that's,
right.
who doesn't need a whole life policy?
Yeah.
Most people.
Right. Okay.
Right. The idea of this growth really is about, and if you're not just looking at trying to keep up with a growing liability, it's great for. But when you're looking into the tax advantaged investing piece of it, which has become the huge push in the industry is that this is, grows tax-free, all these things. But most people don't have the tax problems that require this tool. Their average tax rate's 26%. They still have TFSA room. They have RRSP room. There are so many other avenues that they can take and use to get tax advantage investing. Where that side really, really comes into play is in your people that are in those top tax brackets who have those tax problems, whether that's, individuals who are making 250K plus a year and are in that top tax bracket where the government's taking 53% or over 50% of whatever their money's making, or successful business owners who are past that small deduction piece, who are making more money than they can spend in their business. And so they've opened up a holdco or an investco, whatever you want to call it, to start doing some of that family wealth planning. The problem is when you get to that point, the government says, gimme, 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 and they're going to take a very large percentage of that. And so they have a tax problem. Their money is having a harder time making money for them because of tax interference. And so not as a replacement to that, but as another piece of that overall portfolio, well-designed whole life insurance is mathematically the most efficient investment vehicle they can use because it is free from tax and because it can be accessed free from tax. So you're skipping multiple tax abilities, which multiplies the rate of return. And you're getting that with the volatility of a T-bill. So again, not as a complete replacement. It should never be a replacement. I am a big believer in multiple buckets of wealth, but taking a portion of that and putting it into a policy, a well-designed policy, opens up so many doors. It can't be one, just another piece of risk-adjusted return where you're getting great returns for low volatility. It is an income sequencing tool. So we've got a financial plan, and our financial plan says we're going to grow our money, and then eventually we're going to retire and we're going to spend our money, and we're going to sell off however much we need every year to live the life we want to live, which is great when everything goes according to plan. Now, as we've seen 2008, 2019, right, sometimes, well, the market's down 30%. I don't necessarily want to sell off more than I was planning. And so if we had this other piece, not in replacement, but alongside this, the client's now got options, right? They can say, okay, well, I plan to sell off this many anyways. I'm just going to sell that many. But then they don't have the income they needed to live their life for that year. So they can fill the gap with tax-free money from their policy. Or maybe they say, I know the market's going to rebound. Like, I know Guillaume's got our back, and I know I've seen it every time. The market's going to come back up and we're going to be good. So I don't want to take any money out of this. I want to let it ride, but I still need to live my life. Well, now they have another option to be able to take that money, their whole income for that year, out of their policy. And then what a lot of wealthier individuals who had these policies dated in 2008 and 2019 would say, yeah, I know the market's going to come way back up. So I'm going to take out what I need to live and a bunch more, and I'm going to buy the dip so that as it comes back up, I'm going to get to participate in those returns as well. And so a well-designed policy is never about what a client, at least in my estimation, it's never about what a client should do. It's about giving them options so that whatever those outside forces are at any given time, the decisions are still in their hands. They've got options. They've got the ability to say, I want to do this. I want to do this because of my value system at this current time. And I think, especially alongside good asset management, it is so nice because you get to make easier decisions along with what you want to do and how you want to react to markets, because you're not as worried about the short-term need for access because they've got this other options. I look at it as a great enhancement of all of the other pieces of the portfolio, the assets, the real estate, whatever it's going to be, registered, non-registered. And I think too many advisors kind of position it as a wholesale replacement for that stuff. And I think they're really missing the boat, and clients aren't necessarily getting the best service they could in those instances.
Yeah, I love the way you see it in terms of like as a small portion of the overall portfolio, like as a tool. Like I really echo kind of that mentality. One thing I want to mention though about accessing that cash value, right, in terms of like the times of crisis and stuff. So the way we manage money for clients, and this is based on kind of institutional investment frameworks, I would say. So one is called portfolio immunization strategies. So when you look at like someone's expected expenses, right, over their lifetime, where what you can do is you can take the present value back to today. And what you do is you basically structure their assets, their portfolio in line with that. So for example, 1 to 2 years, and again, that depends on the risk tolerance as well, but just as a high level, right, you want to mix that with their risk tolerance profile. But what did that look like is like, let's say 1 to 2 years would generally be like cash or like high interest savings account, GIC like type of thing. Then 3 years to like 9 years would be the present value would be equal to like a fixed income portfolio with a matching duration. And then 10 years, 10 years plus would be in equities, right? So if you have, that $1 or $2 million portfolio, like you bring that back to today and then would be, $120,000 in cash, $400,000 in fixed income, and then the rest in equities type thing, right? So that my counter argument would be if someone is set up that way with the ability, I guess it's just a cherry on the cake type of thing, or like it's like a nice to have, but it wouldn't be a need in that if someone is structured properly. Would you agree with that? Or what's your opinion?
It's not it's never really a need, right? Until it is, right? For me, it's more, can you get a better return with less variability? Because as we've seen, like interest rates are up higher now. What's the FP
They're done
piece for fixed income return, right? It's like what, 3%?
right now.
Yeah. No. What the FP Canada guidelines are in the long term for what we want to project.
Oh, I don't know by heart. That's a good question. Yeah, it's not a whole. Yeah.
But let's say it's,
sure.
Let's call it 5%,
For
right?
sure.
And that's going to depend on interest rates at the time, whether we're buying 10 or 20 or 30-year bonds, et cetera, et cetera. There's just, if done perfectly, it can be pretty close. Whereas what I like about a properly designed policy is you're essentially getting 5% net on cash over that period of time, which is very hard to get net of income tax, capital gains tax, whatever else. And again, at the end of the day, it's still insurance, right? If they happen to get hit by a bus in 10 years, they don't really care because they're dead, but they're the best dead investor that ever did live because they made about
Yeah.
700% on their money.
Yeah.
For me, it's about simplicity and it's about Sharpe ratios, just about risk adjusted rate of return. And that's just by disintermediating the tax man, right? If you can take the tax man out of it, hooray. And so again, it depends, right? If they've got enough room in their TFSA where that short-term cash flow can be in a tax-free environment, great. There's no one answer, and it doesn't mean that they both shouldn't be in play.
Yeah, when that's maxed out, when your RSP is maxed out, TFSA is maxed out, where do you go? Of
Yeah.
course, that's a stable place. Okay,
And that
I
comes
want to
back to
talk.
what I said, right?
Yeah,
Doesn't need a whole life policy. Most
people. Yeah, no.
wealthy who have tax problems and have run out of those other avenues or are worried about the fact that, okay, I'm putting into my RSP because I get a deduction now and I get to take it out later when theoretically my income's lower. Well, one, maybe it isn't because they're so successful. And two, we have no idea what the tax rate's going to be in 20 years. We just narrowly avoided a 58% marginal tax rate in the budget from a couple of years ago. So the uncertainty, to me, it's a simpler answer that takes out more variables, but it's still got lots of variables to it as well. So there's no right answer in my estimation. It's why examining both and figuring out what a client's values are and what they prefer is always nice.
Yeah. Can you talk about the growth in the policy? So the participating dividends. Give me some color on the estimates themselves. Let's start there.
So the estimate, what you're doing is what they call the dividend scale or the dividend scale rate interest ratio or the dividend interest ratio. It's essentially, I'll get some flack for this, but it's kind of a made up number. It is based on real things. So it takes into account the investment returns inside the par fund. So they take in premiums and they invest them. But that's not just it. They also have expectations on sort of administration and costs. And then they also have expectations on mortality, meaning how many people are going to die. And so if the returns are good and they did better than expected on both those, okay, it may go up. But what I really have looked at is that the dividend scale or the expected rate of return isn't really the story you want to talk about. It's the same way in which if you're looking at two funds and they're both returning 8%, but one has a 3% MER and one has a 50 basis point MER, they're the same return, but they're not the same return at the end of the day to the client. And so the internal rate of return, doing the math on how much the client's actually getting, what they actually have access to, what their real return was, is very important. And then I try to take it a step further because, again, all of that is projected forward. And we're really talking about long-term values. And so things can change. Things can change for the worse. Things can change for the better. So what I try to look at is what's a metric that can be kind of evergreen. It's never going to be perfect, but can be kind of evergreen. And try to look at, okay, what's the efficiency of these? So I looked at companies and said, okay, what are they saying someone's going to get? What's that gross rate of return? And then what is the client actually getting at mortality? So their internal rate of return. And there's a gap between those. The internal rate of return is almost never higher than what they said they were going to give them. But whatever's missing in between there is sort of what was lost to what I'll call insurance costs, the cost of the fund and the insurance and all the other pieces along with it. It doesn't really matter what's making that drain, but that's what clients are losing. So investing is tax free, but that's sort of a tax. It's just a drain on your money, which is all tax is. And so I looked at that and tried to put that in context to know, look, all the companies are probably going to return approximately the same over a 50-year time horizon, similar to institutions or anything else. But if one is going to allow the client to keep more of what they made, then we can make an assumption that that is probably going to yield a better result. But the funny part is that's not even what's really turning clients' minds and what's getting them to go forward. Is there's been a lot of innovation in adding features for clients in these policies, whether that's flexibility on how you put money in or flexibility on how you take them out, or disability benefits or all of these other bells and whistles. And I think the industry is starting to get down the path that we're seeing across all industries, which is user experience is so much more important than some of the numbers. And clients are willing to forego a projected extra 20 basis points if they can get their money in easy, they can get their money out easy, they have added benefits. And so we're seeing a lot of innovation on that side that's driving decisions a lot more than an illustration, which a famous saying by an old mentor, Chris Velardo, is that illustrations prove nothing more than ink sticks to paper.
That's good saying.
Living with that policy, it's so much more important, and being able to bring that context to clients is really at the forefront of me, at least.
There's one thing I want to say on this. So I think you're really right about the illustration itself. Like there's a lot of factors that goes into it, and sometimes using your words like it could look like it's a bit made up, and also like you said, it depends of the different carriers, right? The dividend scale that they assume, and then like the difference between that net kind of internal rate of return and the scale itself, and that's lost, right? But so what would be, let's say in Conquest, right, when we put a permanent policy, like what do you think would be a reasonable, and that would be carrier dependent, but what would be a reasonable growth that you think we should assume for most top permanent policies out there in terms of the scale? 3.5, 4?
I mean, I would use it
3.
You're looking at between 5 and 6.
That's what they state, but I mean after the
that's what I would is between 5 and 6.
And this is accounting for the drain itself?
Mm-hmm. That would be net.
Okay. And then, because what I'm saying is, even though the number itself, like you mentioned, like there's other things that like clients value, which I totally understand, but the lower that return is, the less great insurance is looking compared to the other alternatives. Would you agree?
Not necessarily. I mean, yeah, if
Tell me more
all
about
things
that.
are considered equal, especially if you're looking in that risk profile, the closest
Hmm.
risk profile would be fixed income. And the
Right.
things that would create an insurance policy from returning less than would be generally is fixed income returns over that time. And so they're kind of correlated. But again, one attracts tax, one doesn't. Also, there's I have yet to find fixed income that are returning higher than policies. The other piece is, I think what you may be alluding to was a time in sort of 20, 30, and coming up 15 years ago, where so many policies were looked at. One, they didn't have the innovation to have any kind of flexibility put into them. And two, they were done when interest rates were 12, 13, 14, 15%, and they were priced that way. And people weren't looking at the downward pressure on those. And so there was a lot of policies that weren't built conservatively and did not end up doing anywhere near what they were supposed to, and sometimes collapsed. And so, one, a lot of the policies now were priced and created during historically low interest rate environments. And they've learned so much and they're taking more advantage of the advantages that a par fund has, which is the ability to smooth returns. And they're getting more sophisticated in how they merge their fixed income with their, let's call it the riskier portion of it. Some of them, it's just government guaranteed infrastructure contracts. But I also don't think that we're going to see that wide variation in dividend scales going forward. I don't think we're going to see dividend scales go up to 7 again. I don't think we're going to see dividend scales go down to 5. I think that from an optics standpoint, from a marketing standpoint, from a client experience standpoint, that when they've got good years, maybe hanging on to those a little bit and keeping some conservatism so that when there are lower years, they can bolster those and keep less variability in an already non-volatile instrument, I think is going to serve clients a lot better and serve the industry better. And so that's where I would guess that we're going to see. But yeah, a properly designed policy, even if you look at current -1, right, which is assuming that gross rate of return. So let's call it 6%. Looking at current -1 is assuming that the day that policy goes in force, that now drops to 5 and stays there in perpetuity. Not taking into account the fact that it takes a while for that level of drop to happen and that it'll come back and that there are alternatives that will have the same drop. But any policy that I put in front of a client needs to still work at current -2, which for current -2 to happen, we're dodging people jumping out of buildings or there's been a zombie apocalypse. Like that's for that reality to happen. But so if you can look at it and make your planning around super conservative projections and it still works, now it's, under promise, over deliver is a great way to make sure that clients stay happy. And I've done some interesting things because one of the things that I found is that when it comes to insurance, especially, clients can be okay with the projections not quite living up to what they were projected. What they can't abide, and I don't blame them, is when you said, okay, you're paying into this for 10 years. And then because of that, the agent's got to come back to them and say, okay, we need an 11th payment. That is a deal killer or relationship ender. And so building in safeguards to ensure that that can't happen is really important because surprises are not good for clients. Coming back with those kind of things can be a killer to your business and to your relationship. So, but yeah, I mean, I between 5 and 6% net in a properly designed, properly maintained policy is no brainer.
And then if you do -2, that would be ultra conservative. That's what you're saying. So that
As like
eh,
super
okay.
super conservative, like as
Okay.
conservative as it gets.
Well, we do everything conservative in the planning because even our all equity portfolios, net after fees, it's like just over 6, and then real estate, we do 2%, and we've had some eyebrows like, hey, my house has been growing at 9% a year. I know your house has been going up.
Just went down in price last year.
I
And then
know,
back to that.
yeah. And it's like we do everything. Okay, that's good. Can you talk about how the insurance companies are managing their par funds?
So it's a really interesting question. So there is a bit over the last probably 5 to 6 years, there's been a big evolution in that. And so the general consensus for a long time was that they were basically most the conservative portfolios. They were 70 to 80% fixed income, and then 30% non-fixed income. And that has led to some problems for some of the carriers, especially those that were using short-term bond laddering. And when interest rates were down, it made for some tough times, but they'll come back as interest rates normalize. But what we're seeing now is a lot more innovation in how to get very non-volatile returns, but to make sure that the returns are actually higher than they would be in a predominantly fixed income portfolio. There's things like BMO, which it's not a par. We can get into the difference between non-par and par, but it acts the same. But so BMO is using the equities market, but they're using calls and puts on that to really limit their downside capture. And that's leading to really, really good risk-adjusted returns. You look at a company like Industrial Alliance, who sold more policies than any other company in the country last year and manages $100 billion on their investment side. So they know how to manage money. They're a newer par fund. They introduced the product a few years ago, but they're taking advantage of the advantage of a par fund. A par fund is allowed to smooth their return. So instead of saying, here's our return this year, here's our return this year, here's our return this year, they get to look back over 5 or 7 years and be able to kind of give a meld of those returns to be able to decrease the volatility. And so they said, okay, we're going to take the least volatile portion of this, the fixed income piece, and we're going to make it even less volatile. We're only doing long-term bonds. We're only doing 30-year bonds. And then they got more innovative in what's their non-fixed income, or they're more aggressive. But even that is like government guaranteed infrastructure contracts. So unless the government's going to go bankrupt, it's essentially free yield. So they're doing a much better job of finding that efficient horizon with what they're given to be able to get really good returns without adding risk to the portfolio. And you're seeing Sun Life. So their fixed income portion, they did a really good job at doing a portion of that in private placements. So they have some of that more institutional access and institutional knowledge to be able to assess those risks. And so they're getting much better returns, again, without adding excess risk. And so they were doing very well on that side. But they're all kind of moving more towards, I think they're going to be kind of managed like pension funds going forward. So OTTP is one of the best investment funds in the world. And that methodology, I think, is becoming more prevalent. But it's funny for an industry that's been around for more than 100 years, but they're learning new stuff every day too. And they're getting better and better and better at how to take advantage of what they've got in front of them.
Yeah. One thing I never really understood is if they're investing, right, using all the asset classes, and I used to cover, by the way, lots of the names that you mentioned in my previous role in the industry, I used to cover those guys. But when you look at like they're running a fund, and then you as a client, you come in, you buy a policy, and I guess it's mooted, right, for you because you don't weather the volatility, but they can't give you out more than what they're earning. And they also have to pay operating costs. And I know there's like mortality credits and all that stuff that gets pulled. And that's add probably to the, and all that stuff, right? Probably, I'm sure people canceling. I'm sure there's other reasons there. But if they're making more money than they're paying out, which is the whole point of the business itself, why would people not be able to do that on their own and then be that policy themselves?
And that's what universal life was for.
No, I mean like outside the policy. Like, I mean like,
Tax,
pardon me. Oh, tax.
and a hedge, right? So it's still insurance. So yes, let's say you can mirror their exact return that they're getting. And obviously there's a base. So let's say they're making 8% and you're making 8%. You're Bernie Madoff and you're making 8% every year for 10 years. And then you die. You didn't make what you would have got making that 6% inside of an insurance policy. Like at the end of the day.
Yeah.
So if you're making 8%, then you're paying tax. And let's just say you're at capital gains. Let's say you're losing a quarter of that. Okay, well now you're back down to 6. Right? So now you're taking, but you're doing it assuming that extra risk. Right? And if anybody, right? If somebody thinks that they're going to have access to more inside knowledge, more industry knowledge, more resources than these institutional investors. The same reason why people go to, advisors like yourself. You have a better base of knowledge than your average consumer does. And you study this and you do podcasts about this and you dedicate your life to being as good at this as possible. Just the same way that I'm not going to go to, a guy who's doing pipe fitting and say, well, I think I could probably get that about the same for around that cost. Why am I going to have you come in and do that? Well, because that guy dedicates his life to that every day and is going to be much, much better at it. And so really what it comes down to is the disintermediation of the tax man is if you can get the same or better net results while taking significantly less risk on you as the client and have a hedge and have this be the best collateral any lending institution will ever look at, because once you get those dividends, they're yours for life. And the question that, people ask is, how does the government allow this? Like, how do they keep doing it? But two things, in my estimation, is one, it's a whole lot easier to collect premium tax from 10 or 12 insurance companies than it is to collect it from 10 or 20 million individuals. And two, it makes sure that there's money coming back into the economy, right? And insurance is continuing to have that stuff come back into the economy and grow it when people pass away, when things happen. And so I hope it doesn't go away, but it has consistently been looked at as a net positive by the CRA. And so as long as people are doing it properly, and again, making sure that these policies are in line with the goals of the clients and are there for insurance purposes, then I don't see it.
Yeah, no, that's good. Just to summarize kind of what we've talked to like in the last few minutes here, if someone has the risk profile, to example, carry like 100% equity portfolio, and then I looked at like a number of kind of tables and research around this, of course, they will be better off, and the younger they are, the longer, let's say they have 50-year time horizon, their equity portfolio will be substantially higher than, a policy that is giving you
If
4%.
if they're in the top tax bracket, I've done the math, and it's essentially equivalent to about a 9% net equities portfolio.
Damn. Okay, so that's your calculation. Okay,
That's also within a corporation and assuming tax-free access to that. I would say
okay.
it's probably closer to 7.5.
Still okay.
Yeah,
So it's
but
pretty
that with the
high.
volatility of a T-bill is pretty darn good. And that's why,
Yeah.
as a base, to allow that equities portfolio to perhaps, especially if you're looking at that risk profile who can be in 100% equities and has that longer time horizon, well, then maybe you can chase even more alpha in that equities portfolio because you've got this wonderful, excellent Sharpe ratio base that means when markets are down, you don't have to face the brunt of that. You can wait longer through that. So, not
Yeah.
that I'm telling anybody to chase risk, but I think having a well-designed par policy as part of that allows you to actually get closer to your true risk profile and your true goals as a thing to support that.
Yeah, I love that. So you have your equities portfolio, your fixed income portfolio, and then a portion of your fixed income portfolio can be held inside a par policy, for example, assuming you have a tax play at the end and all the goals are in line.
And it depends. And I know there's a lot of advisors that originally looked at, replacing the fixed income portion completely with par policy, which is, I mean, with interest rates where they at, you're probably going to be better off in the long run replacing that with a par policy. But there's other things. I like having a little bit of both. But with what I've seen with some of the evolution and the flexibility in these policies, especially the advent of ADO and the ability to make that a lot bigger portion, is now in the ultra high net worth, and especially if that capital gains rate change had to come in inside corporations, even as a portion of your overall investment. Like I'm seeing people look at, I guess the heuristic is about 1/3 of sort of non-reg, so put in over 10 years. And so that ends up being, by the time that's done, then probably about 15 to 20% of that overall portfolio. But the benefits that it makes in the long run from flexibility and an end return is fantastic. And again, that's assuming somebody lives to be a ripe old age. If they kick the bucket in the next, 10, 15 years, it's
Yeah.
even better. But that's
Yeah.
where, the ability to add term as a portion of that and to be able to buy some of that tax advantage room at cheaper rates makes things like your granddaddy's in policy is not even remotely close to what is capable now, where the biggest problems were, you had no flexibility in how you could put it in. You were
How do you structure that? How do you structure that today, like in terms of maximizing the ability to maximize cash value and access it?
It depends on the client's situation, so their time horizon, their risk tolerance, everything else. But I really like that flexibility period. And so what I generally do is the most flexibility you can have, the most ADO or sort of dump in excess room that you can get is when you use a life pay or pay to 100 chassis. That being because the tax code says for a certain age and certain death benefit and smoking status, you can tax exempt grow X amount of dollars. And so if you have that amount of pool, but you have to spend more of that money on the pure base insurance cost, you have less that can go into the dump in room or ADO or whatever you want to call it. But so the life pay version of that makes the insurance cost lower so you can put more into ADO. The problem with that, you've now got like a 40, 50-year runway with insurance charges. You can show it at conservative current -2, whatever it is, but it's never truly guaranteed. And so what I did is a couple of the companies came out with the ability to get more of that room using term rider. And so I didn't want to go further than what the life pays were looking at because I think they're well priced and well designed. But what I said was, okay, if we can get this same level of flexibility, but do it with only a 20-year cost model, now we're eliminating another variable. Now we're making this, that much more secure and making sure that regardless of the things that happen in the negative, that the client's going to be okay. And so basically built that same ratio, and it's generally about 40% base to 60% ADO, but doing it within a 20 pay model did a couple things. One, it capped that uh, cost at 20 years. So
Yeah,
good.
can line with retirement, or it can be lined up with like a phased income as well,
Correct.
depending on right.
And what we saw a lot though was that the funding of these, or at least the planned funding, was generally a 10-year time horizon. People like saying, I want to put into this for 10 years, and then I don't really want to worry about it. And again, if you're using a life pay model, that's not guaranteed. And I said, they can take having their returns be lower. They cannot take coming back and saying, I need an 11th premium. Somebody will lose their shit over that. But if you look at using that 40-60 ratio and over a 20 pay cost, but paying it over 10 years, even if the dividend scale went to zero the day after the policy went in force and you paid your 10 years of premiums, you'd have enough in cash value to pay the second 10 years of premiums because you've got twice as much ADO as you're doing base. So now it is, I do not want to use the words guaranteed. So it's not a guaranteed, but if you follow the plan and the dividend scale went to zero, you wouldn't need to pay another premium.
Wow, that's advantageous for sure. It gives a lot of flexibility here.
That's the flexibility, product features, and being able to accomplish goals from a conservative outlook are how I sleep at night. I don't like a lot of advisors in this space, can do it, and then they're worried. Is the client going to change their mind? Is something bad going to happen in the industry? But if you set it up from a space where it's kind of, again, I don't future proof, then you can sleep at night, and you knew you did what's right for the client, and you helped them again make that decision with some ownership and from an informed perspective. It wasn't being sold to them. These are smart people, man. These people, again, not most people don't need a whole life policy. The people that need one, the intelligent, the wealthy, the successful, they are intelligent people. And so they make decisions every day inside their business or inside their lives because they know the cost benefit analysis. They know the ramifications of it. And so if they made this decision with that same level of confidence, it would suck if it didn't do as well as they thought it was going to, but it was their decision. They didn't feel sold on it. They didn't feel pressured. They made that decision from their own set of values and their own circumstance.
Okay, so I want to question you on this, I would say not problem, but this train of thought that I come across a lot. And hear me out here.
Yeah.
A lot of people that we deal with have started accumulating wealth, they've usually outgrown, the advisor at the branch. They've outgrown the path that they're going with. They will be facing a tax liability at that point. Most of them, like I mentioned with you, they're incorporated. They're starting to compound money in their operating company. The next step is like setting up a holding company, start building wealth that way. And then, but they're still at the early-ish stage, but it's growing pretty fast, right? We have clients that you're talking, $400,000 of retained earnings a year. Like, we're talking that scale. One thing that I've come across is I will show them, for example, like the whole plan and everything. And then let's say at the end, it's going to look, anywhere between, let's say 10 and 20 million. And this happened a few times. And then I'll show like, hey, you're at estate shrinkage, but of course, we're still in early talks, right? We're opening the investment accounts and all that stuff. But I'll show the estate shrinkage of about, like, say 20%, right? Just give and take. Assuming they've sold their business before and whatnot. And then, that will shrink the estate for, 2 million, maybe 4 million, if that 20, right? And their response is,
Yeah,
like,
it's a cost of getting rich. That's somebody else's problem. They're dead, right?
So what's been your experience with that kind of scenario where they're like, hey, Guy, if my kids are getting, 12 million instead of 15 because 2 million goes to government, like, what is so
Again,
what
it's a
have
huge difference, right?
yeah, for that, but of course, it's early conversation, and again, I haven't done like a whole like plan into, because if I could show them, let's say you put, I'm not sure what would you experience, but let's say you put like 100 grand or 200 over your lifetime, then you can save, let's say 2 million in tax. Like if you show them the risk analysis and like the cost analysis, benefit analysis, sorry, then they could probably be like, oh my God, like I do want to hedge that risk. But what's been your experience with that actual tax liability at the end?
So one of the interesting things is that's still also sort of in the ether. That's still a projection, right? And so one of the things that I really like to do is introduce some of the other planning aspects that I think get in before insurance or anything else, which is, okay, if your company's worth X now and we think it's going to be worth Y down the future, well, why don't we look at a time in between there where we can do an estate freeze and maybe set up a family trust so that you can multiply your lifetime capital gains exemption and make sure all of those efficiencies are at their best, and bringing in the accountants to do that work, which is, they don't got to do anything other than pay a fee, and they save tons of tax. And it's the tax isn't disappearing; they're just pushing it off onto their kids. And so that one they're generally pretty good with. The other piece is okay, we've got this estate problem to deal with. In this case, let's call it $2 million. Okay, now let's look at how we can solve that, but make that a net benefit to you in the 40 years between now and then. Because you're right, nobody really wants to talk about their mortality. Nobody wants to talk about when they're dead. And sometimes it's like, I'm dead, I don't care. But how insurance that can solve that problem, that's what we're trying to solve. But how do we help them to see the benefit to them that's going to be actually to them while they're alive, and what that means? And if they can get that, have their cake and eat it too, then they're okay with that. And so if you can say, okay, you're putting away 400 grand a year of retained earnings, right? And you're putting that into, investment portfolio, and maybe you're doing some of it in real estate or whatever else it is. Let's take a third of that. Or let's take a quarter. Let's take 100 grand over the next 10 years and put 100 grand, 100 grand, 100. Probably your retained earnings are going to keep going up. But if you have a down year, great. We're going to build you in flexibility so you're really not on the hook for that full 100 grand. But let's just say we're doing 100 grand. This isn't costing you anything. You're just changing where you're investing it. You're putting that money that would go into a taxable environment, and we're just moving that from one pocket to the other to a non-taxable environment. So it's not costing you anything. It's still money that you'd be putting away somewhere. And here's what it looks like over the course of your life. Here's what it looks like while you're growing your business, avoiding the small business deduction because you're keeping the passive income threshold lower. You're building a hedge in case you do kick the bucket because it's still insurance, but we don't need to worry about that. You're now providing an extra access to income in retirement that you can use and better manage your decumulation phase. It's going to be a net asset on the books of your corporation. All of these other things. And they're like, oh, yeah, those are all pretty awesome. Oh, yeah. And when you kick the bucket in 40 years, your kids won't have to pay any tax. Or if you really want to, and you get nearer to the end of your life and you say, you know what, I don't care. They can pay the tax bill. Well, they can burn it all down. They can lend against all that money and go and spend it and do whatever they want. But what I found is the tax bill paid by their kids generally isn't what they care. But especially for business owners, that tax bill is due on the disposition of their business.
Yeah.
And so, yes, your business is worth 14 million or whatever it is, but are you going to have 3 million, 4 million, 5 million in cash sitting around? Probably not, because you grew this company by deploying capital. And so you spent your whole life building this business, your legacy. And maybe they do, but most times they don't. Do you want your kids to have to start selling off divisions or assets inside your corporation, your legacy, in order to pay that tax bill? Or do you want them to have to take out a loan and then be encumbered by that in the long term? And generally they say no. And so if you can say, all right, here's how we can improve your life over the next 40 years. We can give you more control over your tax rate in retirement. We can help you build more money than you would otherwise. We can give you not having to worry about the opportunity cost of that capital. Oh, and as a cherry on top, it's also going to make sure that that tax bill gets paid and your kids can take the time to grieve and to make decisions about your business and your legacy with your thoughts in mind without a deadline or a gun to their head. Yeah. No, okay, that's pretty cool. And that a lot of that comes along with the planning, right? Like having a conversation with the accountant and getting a potential estate freeze and looking at the benefits there. Like right now, the capital gains exemption just went up. It's 1.25 million now. So if you've got a spouse and 2 kids, you're now saving what, 5 million on the sale of your business. So you wanted to sell it, or you didn't sell it because you're passing it on, but that's a disposition to your kids. So you're essentially selling it. Well, there's an extra 5 million of taxable liability that you saved just by doing some structuring, right? Just by doing something that has other benefits and gives you more control. And that's what I've really found is the numbers or the state liability is not what drives those conversations. It's control and flexibility, right? Successful business owners, not as a bad thing, but they're kind of control freak. They got their vision and they've been doing, and they've seen the success and this growth. And there are so many people whose lives depend on them with their employees and everything else. And so they really want to be a part of that and want control over that. And so if you can say, okay, we'll give you another tool in your tool belt to have more control over not just the business, but yourself and your family finances, more control over what you're doing in retirement, how you're accessing your wealth that you've built, what kind of taxes you're paying. And then the trust, there are other things can give you, even after you can have control from beyond the grave, right? You can still have control, make sure that your wishes and your vision are played out. And to me, that's the really effective piece. And insurance is just a mechanism that we use to fund it, right? It's as simple as that. It's just a liquidity tool. It's planning, and it's those conversations that are really helping clients to get what they want.
Well said, man. I'm gonna cap it at here for now, but I'd love to have you back on especially I think we should dive into corporate owned life insurance and the use cases for business owners. I know you've mentioned a few in the last 5-10 minutes here.
We talked about the capital dividend account and all the extra benefits there.
Exactly. I didn't want to go down that route because I know it would open a whole can of worms, and I want to be respectful of your time, but I'd love to have you back, and we should have a whole hour just on corporate owned life insurance, all the bells and whistles around it. I think it would be really interesting, as well as probably maybe another episode on the charitable giving. And then I know you mentioned, I saw on your website, and I'd love to just pick your brain on like how you've used it for charitable giving, because this is the type of clientele that, would be very inclined to look at, again, small costs for huge benefits and all that stuff, right?
And that's why I really love the charitable giving side, is it doesn't have to be about the high net worth, right? It's anybody who wants to do that and wants to be able to give more than their current cash flow allows. Insurance is a wonderful way to do that.
Yeah. I love that, man. Graham, thank you so much for your time.
Thanks for having me. I appreciate it.
It's been an awesome conversation. All the listeners, thank you for listening. As mentioned, you can find Graham's website, so G3 Wealth is going to be in the show notes, as well as his LinkedIn. Any other places that people can find you? LinkedIn website?
Pretty much just LinkedIn. Like I've got Instagram, but I don't really use it. I don't post it. I just kind of look at it. So LinkedIn and then my website, G3-Wealth are the best places to find me.
Perfect. Yeah.
Or
So
just
that's
call
going to
or
be,
email me.
yeah. Okay. Right. That's going to be, all in the show notes. And of course, as usual, you can visit us at mwadvisors.ca, book an intro meeting, subscribe to our newsletter, or, just get in touch if you have questions. Don't forget to follow us on social. And with that being said, we'll see you in the next episode. Thank you for listening.
Au revoir, Guillaume.